Good morning, everyone. On behalf of Vetiva Capital, in partnership with Frontier Africa Reports, we welcome you to today's edition of the Vetiva Breakfast Meeting. In today's session, we'll be hearing from our capital market analysts who will be giving us a rundown of the fixed income and global equities market. We will then hear from our media partners at Frontier Africa Reports, who will be giving us updates from across Africa. Also, we have joining us today a guest speaker, our oil and gas analyst, Luke Ofojebe, who will be speaking with us on oil price dynamics and what lies ahead. I'd like to remind everyone that this meeting is being recorded and may be shared with third parties. Also, the meeting is being streamed live on our Vetiva online Facebook page, if you'd prefer to view from that platform. Also, during the course of the 30-minute session, you may send in questions using any of the chat functions available via Zoom or Facebook. However, at the end of the session, we would have a Q&A segment, and if you prefer to speak, you may use the raise hand function and you'll be called upon to speak. We will now be starting with Sean, who will give us updates on global equities market. Good morning, Sean. Okay, let's start with Omorege. Good morning, Omorege.
Good morning, Victoria. Good morning, everybody. I'll be taking the market update for the Nigerian fixed income market activities for yesterday. I'll start with the money market. The money market is still very liquid. Opening figures for yesterday was about 67.57 billion positive. After we adjusted for repos, market was about 1.57 billion negative. This was a major decline from opening figures that were recorded on Monday, which was about 44.89 billion positive. Despite the decline in system liquidity yesterday, interbank rate losing by over 175 basis points to trade around 16.5% levels from the 18.5% levels that was recorded on Monday. The ease in rates, despite the drop in system liquidity, was largely due to the lack of any major funding need in the market yesterday. Our expectation for today is that the money market will trade at lower levels, barring any significant change to system liquidity. Moving on to the FS markets, the parallel market remained stable yesterday to trade at 502 naira to $1, while the earning window traded at a high of 420.90 naira to $1, closing at 410.83 naira to $1. That's about 45 kobo appreciation from where it closed on Monday. And this was largely due to the significant improvement in earning industry turnover, as it increased significantly by 115% to close at $215.53 million yesterday from the $100.48 million that was recorded on Monday. We believe that the Naira will continue to hover around these levels in the absence of any significant inflow of FX into the system. Moving on to the T-bills market. T-bills market traded on a quiet note yesterday ahead of the NTB auction that is slated for today. We observed offers on the long end of the benchmark curve, particularly on the March 2022 papers, while some trades were consummated majorly along the short end of the benchmark curve, majorly on the July 1st, 2021 paper, and also on the special CBN NTB. Overall, average benchmark rate declined marginally by 1 basis point to close at 6.3%. In the OMO segment, we saw an uptick in market activities with a slight bearish bias because of the shortness of cash in the system. Trades consummated on that end was majorly on the mid to long end of the curve, particularly on the November 2021 and the March 2022 papers. Overall, average benchmark rate rose by 2 basis points to close at 9.46%. At the NTB auction today, the DMO is offering about 81.73 billion. across the three usual tenors. On the 91 days, they are offering 2.88 billion. Our expectation on that end is that the rate will maintain to close at 2.5%. On the 182 days, they are offering 20 billion. We expect rates to also maintain to close at 3.5%. On the 364 days, they are offering about 58.86 billion. We expect a slight decline in marginal rate on that end. Our rate expectation is 9.2% to 9.4%. Our expectation for today is that the T-bills market will trade on a very muted note as the NTB auction takes center stage. I'll conclude with the Nigerian bonds market. The bullish momentum intensified in the bonds market yesterday as the auction papers lost few basis points to trade at levels lower than where they closed on Monday. During the early hours of yesterday's trading session, offers on the 2027, 2035, and the 2050 papers were around 12.1%, 12.9%, and 30% respectively. But bids were hovering around 12.25%, 30%, and 30.1%. As the trading session progressed, we saw a slight reversal in the rates as bids inched up to settle around 12.3%, 13.1%, and 13.25% on the 2027, 2035, and the 2050. The reason for the slight uptick in bids levels was because of the reduced demand on those papers as players opted to buy similar maturities instead of the auction papers because of the low levels that were obtainable. Hence, we saw intense demand on the 2049 maturity during the closing hours of yesterday's trading session. Offers on the 2049 maturity settled around 13% levels. Overall, trades were consummated across the benchmark curve, particularly on the 2026, 2027, 2035, 2037, 2049 and the 2050 maturities, with average benchmark rates declining by 10 basis points to close at 12.65%. We expect the bonds market to trade on a bullish note today. That will be all for fixed income. Thank you.
Thank you very much, Omorige, for that analysis. We'll now be moving to Sheun, our global equity trader, and he'll be reviewing some markets across West Africa. Good morning, Sheun.
Good morning, Victoria, and good morning, everyone. Like Victoria mentioned, we'll be reviewing performance of some major markets across West Africa, and we'll start off in BRVM, where the composite index closed 31 basis points lower. Gains in Vetiva Energy, Safka, and South Cote d'Ivoire weren't enough to pull the market to a positive close, as losses in some of the heavyweights like SMB, CITAL, and CFA, amongst others, ensured that the market had a negative close. We continued to see decent demand in Vetiva Energy on the back of the impressive earnings release, as the counter is currently over 30% up monthly dates. Activity level, however, declined in the session, while year-to-date return of the index is currently at 10.08% for the BRVM market. And going into today, for our expectation, we expect market to close in the green as the index recover from yesterday's decline. And moving to Ghana, it was another flat close, just like the previous trading session, as the index remained unchanged. There were no gainers or losers in the session, even as Cowbank recorded the highest volume of trade in that session. MTN Ghana and Societe Generale were also some of the actively traded names, as we saw a 302% improvement in turnover. The year-to-date return of the Ghana index remained elevated at around 36.16%. And I will believe going into today, for our expectation for that market, we believe the market to trade in similar pattern, with names like MTN and Enterprise Group dominating market activity. We also believe Cowbank should also be a major player in the market today. So for exposure into these markets that we've mentioned, please reach out to us via email at dealing@vetiva.com, and also to our sales team at sales@vetiva.com. So lastly, we'll move to Nigeria. The all share index closed the day in the green. We saw a 15 basis point index appreciation in the session yesterday. We saw slightly positive markets snapping up as investors snap up names across different sectors. We saw Como in the agri space, Dangote Sugar and Nigerian breweries in consumer goods, Oando in oil and gas, and FBN in the banking space, all closing higher. Market stayed mixed in terms of activity as volume traded improved, while the turnover declined yesterday. For sectoral performance, we saw major sectoral indices all close in green, aside the oil and gas that declined, which was on the back of the loss we saw in Seplat. We also saw continuous demand in GT holding. This persisted, and in this session, as well as saw crosses in some large cap names. So for us going into today, which is the last trading day of the month and the quarter, with some level of interest that we have seen in the market and looking at some buying activity, we expect the index to close neutral to positive today, even as we do not rule out possibility of profit taking on some recent gains. So thank you very much. That'll be it for equities market.
Thank you very much, Seun. We will now be hearing from our media partners at Frontier Africa, who will be giving us updates from across Africa. Good morning, Temple.
Good morning, Victoria. And so quickly, we'll take up from the eastern part of Africa, where the East African Community Council has just budgeted $91.7 million for the full year 2021-2022. They did present the budget at a sitting with the East African Legislative Assembly recently in Tanzania. They're expecting $54 million to come from partner countries, $37.6 million to be, which is 41% to be borrowed. EIB, European Investment Bank, is to invest some $95 million in the East Africa's geothermal projects, and that is out of the $4.9 billion financing program that they've come up with for renewable energy and COVID-19 recovery, basically for generally for Africa. You have Ethiopia, Kenya, and South Sudan renewing their commitment to advance their regional development by committing to some highways, railways, and oil pipeline, as well as airports projects. That is supposed to also go up some amounts of money that haven't really been disclosed. The IMF, we understand Uganda applied to them for some financing, for some loan a few months ago. The IMF has granted that loan, $1 billion. It's under the Extended Credit Facility, ECF program. It's a 36-month arrangement under that program, and it's basically to help them support their recovery from COVID-19. We understand that Cameroon has also just signed an MOU to build $10 billion land port rail. It was signed with two Chinese companies, one based in Hong Kong and the other comes from Australia. The objective rather is to construct this railway from the coast of Cameroon to the large cross-border where there's a large deposit of iron ore. South Africa's deputy governor did say he expects their bank to continue to be dovish in terms of monetary policy. Zimbabwe's inflation came in lower at 106.6% in June compared to 161% in the preceding month. And in the northern part of Africa, Egypt's foreign debts, IMF do expect that will hit around 36% of GDP by the end of this year. And of course, the parliament in that country has just approved the Sovereign Sukuk Act, something to basically regulate the borrowing under the Islamic or non-interest financing scheme in that country. These are some of the headlines we can share at the moment. Thank you for listening.
Thank you very much, Temple, for the updates. We'll now be hearing from Luke Ofojebe, our oil and gas analyst, who will be speaking with us on oil price dynamics and what lies ahead. Good morning, Luke.
Good morning, Victoria, and good morning, everyone. So like Victoria said, today I'll be taking us through the trend in oil prices, as well as discussing our expectations for the rest of the year. So following the news that effective vaccines have been developed for COVID-19 late last year, we saw a rally in the oil markets. That's pushed oil prices, especially for Brent, to around $50 a barrel. And that rally continued into 2021, mainly supported by improvements in global oil demand, as well as supply costs from OPEC and its allies. So the improvements we've seen so far in global oil demand has been driven mainly by rising rates of vaccination in advanced economies. Say, for instance, Europe and North America account for about 40% of crude consumed in the world. And in these two regions, vaccination rates are already above 30%. That's far more than 2% that you can find in developing markets. And looking at the shape of the oil markets, currently, the market is deep into backwardation. So what this means is that current spot prices are actually more than the prices you find in the futures market. The implication of this is that oil traders currently are willing to pay a big premium to secure physical barrels of crude today. So looking forward, what do we expect for oil prices? So for us at Vetiva, we expect Brent price to average $64 a barrel. And that's below the current price of $75 in the markets currently. And the reason for this view is driven by the fact that there are a few downside factors that may materialize in the second half of the year. Firstly, looking at what's going on between the US and Iran, I mean, so far we've seen some progress made on the negotiations going on between the two parties, and it's likely that the two parties might still reach an agreement in the second half of the year. So what this means is that the US may likely lift the sanctions on Iran, and the country can resume its export of crude to Europe and China, and that can lead to increased production from the country. For us at Vetiva, we see crude production in Iran probably rising from 2.2 million barrels that it is currently to around 3 million barrels by the end of the year. So that should weigh on oil prices. Secondly, because of the economic downturn we witnessed last year, a number of shale producers in the US decided to cut their capex spend significantly. So they reduced their drilling activities significantly, and that led to declines in oil production in the US. But looking at where oil prices are currently, for WTI, which is around $70 a barrel, that's already significantly more than the break-even price for shale in the US, which is around $40 a barrel. So we see that as a strong incentive to shale producers in the US. We see them, spending more on drilling activities in the second half of the year. So that should translate to increased food production in the US, and that also should weigh on oil prices. The third factor we see is the fact that there are still fears around COVID-19 spread. And more recently, there is another variant, which is the Delta variant, which is more deadly than previous variants of COVID-19. And because of fears around the spread of this particular variants in developing countries where vaccination rates are relatively low, there are concerns that we might see another round of lockdowns in these countries, and that should also, weigh on oil prices. Then in all of these, like I said at the start, I mean, we expect Brent price to average $64. Then the next question might be, what should be the implication of this for the Nigerian oil sector? So clearly, for the upstream players, this should be a major positive. I mean, we are looking at average Brent price moving from $44 last year to $64. So clearly, we should see an improvement in oil revenue for both the government and the oil producing companies. For instance, for Seplat, we expect oil revenues to rise by 40%, and that should significantly support the company's bottom line. And that really explains why we've seen a significant rally in the company's share price so far in the year. currently the shares of surplus are trading around 690 naira. That's a significant improvement from 400 naira that it closed at last year. And more so for the government, I mean, because of the improvements in oil revenue, it means that its ability to finance capex expenditure in 2021 should also improve. Then on the flip side, the major downside, the major negative implication we see as a result of rising oil prices is going to be observed in the downstream sector. And that's because we are yet to have a deregulated market for PMS. So looking at current pricing, I mean, landing cost of PMS is around 230 naira a liter. And that's due to the fact that Brent price has risen to around $75 a barrel. And at the moment, the NNPC sells PMS to the oil marketers at a price of around 157 naira a liter. So that translates to a subsidy expense of around 73 naira a liter. And given that NNPC imports on average 50 million liters of PMS into Nigeria every day, so that takes daily subsidy expense to around 3.6 billion. Clearly, this cannot be sustained for the rest of the year, and that's why we are seeing intense negotiations going on between the NNPC and the Labour Congress. So even though we are not going to see a deregulated market for PMS, it's very likely that the price cap of PMS could be raised from 165 that it is currently to around 185 or 190 naira a liter, just to reduce that subsidy expense on PMS importation into the country. So with this, I believe I've now come to the end of the presentation. Thank you all for listening. At this point, I would like to pass the mic back to the meeting coordinator, Ms. Victoria Ejugu.
Thank you very much, Luke, for the update. We have now come to the Q&A segment. If you have any questions, you may use the raise hand function so that we can unmute you and you may speak, or you can use the Q&A function to ask your questions. And also those joining us from Facebook, you may use the comment section to type in your questions, and your questions will be read out and they'll be answered. I can see that 2 participants have their hands raised. Okay, hi Ifeanyi, you can now speak.
Okay, yes, good morning, Mr. Ofojebe, the expert on oil. My question is, with this oil price hovering around $75, $76, is Nigeria really benefiting from it? Do we have the production to take advantage of this high oil price at the moment? How come oil price is rising and our reserves, external reserves, are falling? Normally, it's supposed to be rising and not falling. What could be the issue? Thank you.
Thank you very much for your question. So I mean, in terms of where oil prices are currently, Brent price around $75. I want to understand why we are not seeing that material impact on our foreign reserves. So speaking on production, like you said, I mean, currently, Nigeria's crude production, that's oil production is around 1.5 million barrels. And given the fact that OPEC and its allies, I mean, considering where oil prices are currently, they're actually looking at reducing supply cuts. So on that note, we should see a bit of respite on production levels. So we might see oil production rising to around 1.6 or 1.65 million barrels in the second half of the year. And by the time you also factor in condensate, I mean, total crude production can improve to around 1.85 million barrels a day, and that should significantly support government's oil revenue, given the fact that oil prices are still going to remain at high levels compared to 2020. Then speaking on the impacts on foreign reserves, clearly that's a positive for foreign reserves. It should result in upward movements in foreign reserves. But that has not been the case lately, and that's because of the fact that we still have foreign investors who are exiting the country. So there is still that pressure from foreign investors. That's foreign portfolio investors this time around, exiting the country because of worries around our exchange rates, the likelihood that we might see another devaluation, given the widespread between the rates you find in the NAFEX markets and the rates in the parallel markets. So because of these concerns, foreign investors are leaving the markets, and we're seeing downward pressures on foreign reserves. The second one is the fact that, for Nigeria, we understand that CBN is coming up with unorthodox means to just, control FX and also to keep our reserves relatively stable. But we also need to understand the fact that the country in itself, in its economic reality, is actually import dependent. And given the fact that we have, pressures from major importers, especially even at the NAFEX window, because they need FX to finance most of these their import obligations. So there is also that downward pressure on foreign reserves. However, given the fact that the government is actually looking at raising Euro bond in the second half of the year, that should help to raise our foreign reserves a little bit.
Thank you very much, Luke. Thank you, Ernest, for the question. We also have Ifeanyi, who has a question. Good morning, Ifeanyi. You can ask your question now.
Okay, good morning, Luke. This is Ernest. Actually, it was Ifeanyi that asked initially.
Exactly.
Okay.
Yeah.
Thank you, Luke, for those succinct, brief, and insights. So my question is actually very, very short. Okay, sometime yesterday, we read in the news that NNPC wants to borrow about 4 billion to acquire some form of stake in Dangote refineries. So in your opinion, what do you think is NNPC's interest in Dangote refinery, and why borrow to acquire a stake in it? Thank you.
Thank you, Ernest, for your question. That's an interesting one. Yeah, like you said, NNPC is planning to, raise funds from banks. That's around $3.6 billion to finance its equity stake in Dangote refinery. Currently, it's clear to everyone that Dangote refinery is going to be the game changer in the downstream sector, given the fact that the state-owned refineries, they actually have aging equipment and all that. So even with the yearly turnaround maintenance operations, capacity utilization has never exceeded 10% within the last 10 years. So the focus right now is on Dangote refinery. When is it going to come on stream? There are news, there is news that it can actually come on stream in 2022, but that's actually bullish. In my view, maybe 2023, 2024, that's when it can actually come on stream. But that's not even the point here. So the point here is this: Dangote refinery is going to be the game changer. We are looking at a refinery that can, refine about 600,000 barrels of crude and produce about 53 million liters of PMS. That's even more than the daily consumption of PMS in Nigeria. So it also gives the refinery the room to export to other neighboring African countries. So for NNPC, it's mainly a strategic move on its part in order to just, capture some economic gains from this refinery in the future when refinery starts, producing and starts, recording profits, and we start seeing growth in profits. So it's more like a strategic move on the part of the government in order to also, be able to generate income from the refinery, basically. And it's mainly going to come in the form of dividend. I think the model is going to be similar to what you have for NLNG, where you have the government as one of the shareholders, at the end of the financial year, they will just, share the profits as dividends. So I think that's what's going to be the model for Dangote Refinery as well.
Okay, thank you, Luke. Apologies for the mix-up, Ernest. Thank you for your question. We also have Fola who has a question. Fola, you may now speak.
Good morning. This is Fola. My question is with respect to the subsidy payment on currently on the price of petrol, with the price of petrol still pegged at 160, and it was in the news that the landing cost of oil currently is around 220, 230, which then leads to high subsidy payments on the price of petrol that we have now. So the question is, when do we think the government or federal government will increase price of the pump price? Or is it that they are comfortable paying this subsidy, which is costing them a lot? Because the earlier question that was asked was that with the increase in price of crude, the foreign reserve should actually be increasing. And why is it not increasing? That it won't increase because a lot is also used in paying this subsidy. So when do we see the government increasing the pump price, or are they comfortable paying this subsidy? Thank you.
Thank you for your question. I mean, left to the government alone, the government would have raised the price of PMS maybe since Q1. I mean, we saw that intention to do that, but because of steep opposition from the Labour Congress, they could not. So they had to leave the price cap at around 165 naira a liter. And given where landing cost of PMS is currently, clearly that daily subsidy expense cannot be sustained. And like I said, we are seeing negotiations going on between the Labour Congress and the government on what the price dynamics for PMS is going to look like in the second half of the year. It's hard to tell when that price hike might happen. I mean, looking at current economic realities, I mean, headline inflation is around 18%, food inflation is around 20%. So there is that socialist view that, economic realities are actually harsh for Nigerians right now. So it's going to be a lot of burden to then increase, the price of PMS, given its impacts on various on the prices of various items. So I really cannot tell you for sure that this is when it's going to happen, but it's very likely that towards the end of Q3 or at the start of Q4, we might see an increase in the price cap, maybe from 165 to around 185 or 190 naira a liter.
Thank you, Luke. Thank you, Fola, for the question. We also have 3 questions from the Q&A box, but there's one that is similar. So it says, why is external reserves still plunging considering the increase in oil prices?
I think I've already explained that. I mean, the reason is because, foreign investors are still exiting the country. So there is that downward pressure on foreign reserves as a result of capital flights from the country. More so given the fact that the country is import dependent, so that affects demand to finance their import obligations. It's also weighing on foreign reserves. So these are the 2 major factors why we are seeing, downward pressure on our foreign reserves.
Okay, thank you very much, Luke. We also have 2 questions speaking to the fixed income market. It says, how do you see the supplementary budget affecting yields? And what is your updated view of yield trajectory in July and August?
Okay, thank you for the question, and good morning again. So for supplementary budgets, that translates to stronger supply, and this basically would mean, again, yields inching up on the back of increased supply. And we'll see from the last bond auction that despite the strong front running by local players or market participants generally, we still saw basically that though yields moderated, but it wasn't as strong as market thought because DMO again saw an opportunity to take funds in line with budget trajectory, i.e. supplementary budget, or the fact that they even need to borrow to run the budget, to run the government, amongst others. For July and August, like we've seen from the last auction, for bonds auction, we saw the 2050s, which closed at 13.7, trade up until about 13.1 levels yesterday. So that's over 60 basis point drop in just about 4 days, basically. And we've seen that, again, on other auction bonds, 2035s, 2027s, we've seen that play out. We think we'll see two reversals in between. We saw some towards end of trading yesterday, where we saw a bit of reversals in yields, and buyers just staying on the sidelines to see whether you get some supply interest from market players. We think that would go on into today. We'll see slight reversals, but we'll see buy side players still coming in to cherry pick in the course of the next few days. So in July, we still see something flat. We'll see yields inch back up a little from this strong rally that we've seen, for two reasons. Again, as we approach the auctions, we'll see some short players coming into play. We'll also see people positioning against the fact that the DMO will borrow more. So July, we still see a bit of a flat performance, but going into August, we expect that yields will start inching back up on the back of the supplementary budget, as you have noted. That's our view for the auction, for yield performance in the next 2 months, basically. Thank you.
Thank you very much, Dapo. We have now come to the end of today's session. On behalf of Vetiva Capital and our media partners, we thank you for joining us today and hope that we see you at tomorrow's session. Thank you and good morning.